Rich people often don't become wealthy by chasing excitement. They build wealth by owning boring businesses that quietly generate money every single day. While the public is usually drawn to flashy startups, trending tech stocks, or viral crypto projects, many of the world's wealthiest investors consistently prefer industries that seem slow, regulated, and uninteresting on the surface. At first glance, this looks counterintuitive. Why would someone with billions of dollars invest in electricity grids, railways, insurance companies, or waste management systems, instead of high-growth tech companies or disruptive startups? The answer lies in how wealth is actually created and preserved over long periods of time. To understand this, you need to shift the focus from excitement to economics, from hype to cash flow, and from short-term gains to long-term systems. Wealth is built on predictable cash flow, not excitement. One of the most important principles in finance is this: wealth is not built from unpredictable spikes in value, but from consistent and predictable cash flow. This is why investors like Berkshire Hathaway, under Warren Buffett, have historically favored boring businesses. Buffett is famous for avoiding speculation and instead buying companies that generate steady earnings year after year. For example, Berkshire Hathaway owns large stakes in insurance companies like Geico and utilities such as energy providers. Insurance may not sound exciting, but it has a powerful financial structure. Millions of customers pay premiums regularly, and only a portion of claims are paid out. This creates a steady pool of capital called float, which can be reinvested for decades. From a business perspective, this is far more valuable than a company that might double in price one year and collapse the next. Boring industries are built on essential human needs. The reason boring companies are so powerful is simple. They are tied to basic human survival and daily life. Think about your normal day. You wake up, turn on electricity, use water, travel on roads, use internet services, and consume goods transported through logistics systems. Each of these actions depends on large, often invisible companies operating in the background. Utilities companies like Duke Energy or NextEra Energy supply electricity to millions of homes and businesses. Without them, modern life stops instantly. There is no optional demand here. Electricity is required every single day. Similarly, water utilities, waste management firms, and transportation infrastructure companies operate in the same category: essential services with constant demand. Even during recessions, pandemics, or geopolitical crises, people still need electricity, water, food logistics, and communication services. This creates a powerful stability that speculative industries simply do not have. High barriers to entry protect these businesses. Another reason wealthy investors love these industries is the existence of extremely high barriers to entry. Try building a competing electricity grid in a country already served by an established provider. It is practically impossible. The cost of infrastructure, government regulation, land acquisition, and technical complexity makes duplication unrealistic. This is known in economics as a natural monopoly or regulated monopoly. Companies that already exist in these sectors often become long-term dominant players simply because competition is structurally limited. For example, railway systems in many countries are operated by a small number of companies due to infrastructure constraints. Similarly, water supply systems are usually managed by regulated local utilities. These barriers protect profits and reduce competitive pressure, which is exactly what long-term investors want. Insurance, the quiet wealth machine insurance, is one of the most misunderstood but powerful financial industries in the world. Companies like Allianz operate on a simple but powerful model: collect small payments, premiums, from millions of people, then pay out claims only when certain events occur. Because not everyone claims at the same time, insurance companies can predict outcomes using statistics and probability. This transforms uncertainty into a manageable financial model. Warren Buffett has often called insurance the backbone of Berkshire Hathaway because it provides a constant stream of investable capital. From a business standpoint, insurance companies are not chasing hype. They are leveraging mathematics, probability, and scale. That is why they remain profitable across decades. Cash flow over headlines. Many beginners in investing focus on price movements and news headlines. Which stock will double next month? What is the next big startup? Which crypto will explode? But professional investors think differently. They ask, Where does money flow consistently every day? What businesses will still exist in 20 years? Which companies have stable and predictable earnings? This difference in thinking separates speculation from investing. A company like Amazon or Tesla may dominate headlines, but utilities, insurance firms, and infrastructure companies quietly generate stable earnings regardless of media attention. Compounding, the real engine of wealth. One of the strongest reasons wealthy people prefer boring companies is compounding. Compounding means reinvesting profits so that money generates more money over time. For example, if a utility company earns steady profits every year, those profits can be reinvested into expanding infrastructure, improving efficiency, or acquiring new assets. Over time, this creates exponential growth. Even if growth is slow, say 6% annually, it becomes extremely powerful over decades. A business growing steadily at 6 to 8% per year for 25 years can outperform a hot company that grows rapidly for a few years and then collapses. This is why long-term investors often outperform short-term traders. They allow time to do the heavy lifting. Inflation protection, hidden in boring businesses. Inflation reduces the value of money over time. However, many essential service companies have built-in inflation protection. Electricity providers can adjust tariffs. Insurance companies can increase premiums. Transportation and logistics companies can adjust pricing based on fuel and operational costs. Because demand remains stable, customers continue paying even when prices increase slightly. This ability to pass inflation onto consumers makes these businesses extremely valuable for preserving wealth over long periods. Real-world example. The power grid and utilities consider the electricity sector. Companies like NextEra Energy invest heavily in wind, solar, and grid infrastructure. While these investments are not exciting in the traditional sense, they generate long-term contracts and predictable revenue streams. Governments also regulate these industries, ensuring stability and fair pricing. Compare this with a tech startup. High growth potential, but also high failure rate. One relies on stable infrastructure. The other relies on constant innovation and market attention. Wealthy investors often prefer the former because it behaves like a machine, not a gamble. Warren Buffett and the philosophy of don't lose money. Warren Buffett once said his favorite holding period is forever. This reflects a philosophy centered around durability rather than excitement. His strategy focuses on companies that are easy to understand, have predictable earnings, serve essential needs, can survive economic downturns. This is why Berkshire Hathaway has invested in railroads, utilities, insurance, and consumer staples, industries that rarely make headlines but consistently generate cash. The psychology behind boring investing there is also a psychological reason why these companies work so well for wealthy investors. Most people are emotionally drawn to excitement. They want fast returns, dramatic stories, and instant success. But markets reward patience, not emotion. Boring companies force investors to think long-term. They don't create daily excitement, which reduces impulsive decision-making. In contrast, volatile assets often lead to panic selling, greed cycles, and emotional mistakes. Wealthy investors understand that avoiding emotional decisions is just as important as choosing the right assets. Systems versus speculation. At the core, the difference is simple. Speculation focuses on price movement. Investing focuses on systems that generate cash. Boring companies are systems. They operate continuously, regardless of news cycles or social media trends. Every time you turn on a light, pay an insurance premium, or use public infrastructure, money flows into these systems. Wealthy investors aim to own a small piece of that flow. Long-term thinking wins. Most people think in weeks or months. Wealthy investors think in decades. A speculative investment might deliver quick gains, but also carries high risk of total loss. A stable utility or insurance company may grow slowly, but it rarely collapses. Over long time horizons, consistency beats intensity. This is one of the most important lessons in finance. Survival is more important than speed. Boring is the foundation of wealth. The biggest misconception in finance is that wealth comes from excitement. In reality, wealth comes from ownership of essential systems that society cannot live without. Electricity, water, transportation, insurance, and logistics may not be exciting topics, but they are the backbone of modern civilization. And because they are essential, they generate predictable cash flow for decades. That is why wealthy individuals and institutions quietly invest in them, not because they are flashy, but because they are reliable. In the end, wealth is not built by chasing what is trending today. It is built by owning what will still matter tomorrow, next year, and even decades from now. So the real question is not whether these companies are exciting. The question is, do you want excitement, or do you want ownership of the systems that keep the world running? Because in finance, boring is not the opposite of powerful. Boring is what power actually looks like when it compounds over time. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.